Hi. This episode of Carey Wallace is dynamic. Get your coffee because you have to keep up. She does a lot of really fun things. And instead of asking vanilla questions, because this is an area I'm super interested and super passionate about, I ask her a lot of the deeper questions about her business model. So if you are someone, looking to get valuation on your company, looking for an exit strategy, whatever that is, check out this episode and take some notes because I was hitting her with questions and questions, questions. This is maybe one of the episodes I talked the most on. And I hope I didn't overtalk the guest, but I'm sure when you finish with this episode, you're gonna have more questions just like I did, right? So I hope you enjoyed this episode with Carey Wallace. Hi, welcome to this episode of Industry Voice. Today we have a special guest, Carey Wallace. How are you, Carey?
I'm doing well, Jeff. How are you doing?
I'm great. It's awesome to have you on a podcast with me. And this is actually the first time we spoke, right? This is the first time we speak to each other.
Which is crazy, right? Like
Yeah.
I've known of you for a very long time. I have no idea if you know who I was, but I absolutely know who you are. So yeah.
Yeah, I have been following you and your journey. And for those of our audience that doesn't know Carey, and we're here to tell her story. And this show is about storytelling of the people who tell stories. And Carey have her own community that she built. And that community is from everything from the things that she worked on to the things that she does. So she have a podcast and it's a pretty good podcast. I have listened to a couple episodes and I'm a fan.
Thank
So
you.
I'm going to turn the mic over to you. And if you can just tell our listeners about how'd you end up in insurance, how'd you get in insurance, and just take us through your career of insurance, your personal transitions, and what led you to do podcasts and tell the stories of our community. So if you can, the mic is yours.
Awesome. Well, thank you. So I've been in the industry for about 16 years. And like many people, it was not a place that I thought I would be. It wasn't like it was a lifelong dream to be in the insurance industry. I kind of fell into it. It was actually my second career. So my first career was in a tech startup, and then I have two children, and I decided to actually stay home with both of my girls for a really long period of time, which honestly, as a female leader, you don't really talk about. Like when I first came back into the industry or into the workforce, it's tough to know if you're even marketable. So I applied to come back into the workforce when my girls were headed to middle school. And so I just wanted to work while they were in school. I didn't have a huge aspiration. My first career was a pretty big aspiration. And so I really wasn't sure what that would lead to. And that job got very big very quickly. So I joined a state association that was looking to merge the Big I and the PIA at the state level in Ohio. We lived in Columbus, Ohio at the time. So I joined that association. I had a background in M&A. Neither one of those CEOs did. So I joined as in their accounting department and was promoted into their CFO role. And we ended up being able to work out that acquisition, which was fantastic. But honestly, Jeff, I thought I'd come do this little project and then figure out what I really wanted to do because insurance didn't sound all that exciting to me. And what happened was I met the agents on both boards and realized they're pretty incredible people. And it was it was just a great opportunity to do what I had done in the past, but do it for small business owners across the country. So once that merger was completed, the boards asked themselves, as a trade association, what is our value proposition going forward? And they came up with two things. They said agents need help buying and selling. Right now, they're doing it without the right information. And number two, we have a ton of data and we're not putting it to work as an association to help agents. So I led both of those efforts. created a data analytics company, which I was the CEO of. And we also created valuation and perpetuation planning services. Honestly, was doing 3 full-time jobs at that point. I was the lead consultant. I was running the data analytics company, and I was still the COO of the state association. And, once my girls graduated from college, it was like, maybe I just want to figure out what I want to do rather than all 3 things. So I created my own business because I loved consulting with agents, and that's where Agency Focus was born. So I've been doing that for 3.5 years. And honestly, about a year in, I got to hear so many agents' stories that other people weren't hearing. And there was repeat in the engagements. And I thought, I really like to give a voice to that so agents can continue to learn from each other. And bonus, I get to do the podcast with my daughter, who also entered the industry. So that's kind of how it was, it seemed like a natural fit to help shine a light on that process when you don't really get the behind the scenes of what happens when you buy an agency, when you sell an agency, when you're looking to grow your agency. So that's what we focus on.
I just thought about this, and I should have known ahead of time. For the next episode, when Carey Wallace come back on the pod, we gotta have your daughter on. I mean, you all see like industry, like father and son, son inherited agency with father will build something. But you guys have a mother and daughter relationship that y'all build something, and that is cool. So yeah. I have 2 daughters, right? And I love to see one day my wife and our daughters get on that podcast together. So let's make that a goal, Carey. Let's have you and your daughter. What's her name?
Her name's Lindsay. She would love to come on. I mean, honestly, Jeff, she's far more impressive than I'll ever be. That's for sure. Like, she's an amazing person. Yeah.
Okay, Lindsay, if you're listening out there, let's do an episode with Carey, and we'll have some fun. But I want to go back. And, you give me the macro, right? So I want to compartmentalize it, and let's go down to the micro. When you were building out this consulting thing, because you've seen a lot at OIA, Ohio Insurance Agent Association.
Sure.
What was those tidbits of here, this is what we're struggling with, here, this is what we're having a problem with, this is what we need over here, that you had that aha light bulb moment? Well, was it like a bunch of little things, or was it just 1 or 2 things that aha light bulb moment? And you're like, you know what, I'm going to build intelligence, I'm going to build Catalyst, I'm going to build Agency Focus, I'm going to build Refocus Podcast. I mean, what was all the thing that you saw that led you to found each company? Because even though the show called Industry Voice, I also have another show called Founder's Journey, and I think you are just perfect for that episode as well. But let's stay with, what did you see that led to each one of those ideas? Like, I found the problem, now I'm gonna go build a solution.
Yeah, so let's start with OIA, because it wasn't just me who saw this. In fact, I would really say it was a group of agents that identified what they needed from their state association. What could that relationship become? And the reality is, Ohio is a unique state because at the time we had 1,300 members. So we had a really nice footprint just in the state of Ohio, but we also had a leadership team that was very forward focused and thinking about what is our value proposition to help this industry on a really significant level. So the biggest thing that was the catalyst of the consulting was we write their E&O. So we write agents E&O as a state association. It's one of the largest revenue streams in most state associations. And by doing that, you are notified when an agent has sold because they need a tail policy. And what we would find is we would get the agreement, the sale agreement, and be able to read through it and see the terms. And oftentimes there were problems in those sales. There were there's agent books of business inside their producer-owned book of business. They were written as a multiple of revenue. Sometimes the premium was mentioned. Like it was very easy to see that agents were making decisions based on what they heard other people do. And we could help. We could absolutely create services for them that is affordable, that makes sense, that would actually help them make stronger financial decisions. So that's how the consulting was built. And honestly, it was about, we know M&A is not going to stop. There's no two ways around that. Agents are valuable. And if you're going to do it, make sure that you have the right resources. So there were people in the space. Obviously, Marshberry and Reagan were there, but the average valuation was like somewhere between $8,000 to $10,000. So an agent that is the average agency, which is under $1 million, maybe 750,000, is not going to plan and spend 8 to 10 grand to get a valuation to do an informed decision. So the whole process, the whole idea was, how do we make this affordable and help people make strong financial decisions? That's how that was born. And honestly, it's my background. I have a degree in finance. Like I'm the least insurance person you've ever met, but I'm a strong business person. So I wanted to help them, bring my expertise to help them make good decisions, whatever it is. If they want to transition internally, they want to sell externally, if they want to grow their business, like how can they really understand their business and know what to do to position them for the next? And so that's what started it at OIA, but it's also what the foundation is of Agency Focus, because that's my passion. Like that, of all the things that I did, that was the thing that gave me great joy, that I felt like I was able to help somebody, combining their knowledge and my knowledge to get to a better place together. Intel Agents was really driven by agents on our board, saying, as a state association, there's 1,300 agencies in Ohio. We have insight into their business because we write their E&O. What if we took that and benchmarked them and actually helped them learn from each other, aggregated the data, and was able to help them understand what drives growth inside their business? What is the commonality between agencies in order to know what moves to make in order to help themselves? So that business was built out of OIA, and we were the largest shareholder in it, but also 7 other state associations. So now we have a footprint of over 20,000 agencies data, because remember, state associations write their E&O. Now we can get to really incredible data and insights where we can benchmark them. Compensation was one of the biggest things that agents don't know. That was what that whole idea was about. Intel Agents doesn't exist anymore, unfortunately, and it's because there's competing priorities in a state association versus a for-profit entity. And so, at that point, I'm a for-profit girl. Like, I came from a tech startup. I came to the state association to help those businesses come together. And I think like a for-profit person. So it was a great natural progression for me to start my own business and build the services that I think agents need. So that's where Agency Focus is, where we do valuation, perpetuation planning services, and fractional CFO work. So yeah, lots of things, but it's an evolution of what I think the industry needs and how I might be able to leave it better than I found it.
Great intro. And I'm looking at a post on Agency Focus LinkedIn page, 3,380 followers from yesterday, 791 agency clients across 49 states, 24 state Big I Association partners. Pretty impressive. And you guys have network partners with Combined and Indian.
Yeah.
So who's your first customer that you remember when you set out to build Agency Focused? Thank you for all your support to our channel. Here is a quick word from our sponsor. Please click on the link below in the comment section to sign up for a demo with Track AI.
What if your insurance sales conversations could work harder for you? Meet Track, your AI-powered conversation intelligence partner. Track automatically captures and analyzes every customer interaction, providing instant call summaries, risk analysis, and AI-driven coaching insights. Say goodbye to manual note-taking and hello to more selling time. Track handles the admin work while you handle the revenue. Fully integrated with your favorite platforms. Plus, get custom AI analysis tailored to your unique business needs. Transform your sales team's performance with Track. Visit track.ai today.
Click the link in the description below to schedule a demo with Track today.
Oh, I know exactly who my first customer was. It's an agency in Oklahoma. He was transitioning ownership to his son, and they engaged me to do a valuation of their agency and really build that transition plan. And honestly, they're still a CFO client of mine. So not only did I help the current owner, I'm now mentoring the future owner to really understand the financials, understand the business decisions, being able to weigh his options as he's adding tech and creating lead sources inside that agency, and how does that impact the bottom line profitability. It's one of my favorite clients, to be quite honest with you, because they want to try new things, but there's this difference between someone who's had 30 years in the industry and someone who has 30 years ahead of themselves in the industry. And I'm able to actually help translate the gap between those two people, and be able to leverage the foundation that his dad built and how he can take it to the next level and be the financial voice in that conversation. So incredible agency and such a bright future, like really great agency.
So let's just say I am one of the 35,000, agency owner looking at sunsetting. I'm looking at Margaritaville in Florida. What's the process? As hey, Carey, I am now ready, emotionally ready to let go. What is the process? Walk us through that. Like for those of the audience that have seen all their colleagues, their peers have gone through the exit strategy, exit stage.
Yeah.
Walk me through it.
Yeah. So you actually said one of the pieces that we start with, which is, for you to have a successful transition, there's three things that have to happen. You have to be emotionally ready to go to the next step, which is probably the hardest one. The business has to be ready, and you personally have to be financially ready. So those three things are like the three stool legs, if you will. If one of them's not there, it becomes really difficult. So if someone engaged with me first, I'd have to say, like, what's your timeline? Why did you call me, and how can I help? And if they're like, I want to get a valuation, I think I want to plan my strategy for my exit. Great. We would value the agency right now. You need to know what you have so you can determine, are you financially ready? Because you need to know what one of the largest assets you have is valued at today to even know how that combines with your other assets. Is this something that you're ready to do? So we got to answer that question. Certainly, are you ready to exit? Because if you're not, it's a moot point. Like, there's so many agents that this is who they are. Their clients or their friends, they're so ingrained in their community, they can't imagine doing something else. So you have to be able to answer that. And then by doing the valuation, we'll be able to say, is the business ready? So if you start that process 5 years in advance, we'll be able to say, here's where you are, here's where you could be, and here's 5 to 6 things you could do to strengthen your position, whether you want to transition internally, whether you want to evaluate whether to sell externally. And now you have options. But if you wait and you want to do it in the next 6 months, your valuation is your valuation, and the options become limited, especially if you want to transition internally. So we start with, where are you and where would you like to be? And then what are the things, like, do you have an internal option? Is that what you want to do? Do you want to explore the external options? I can counsel someone on what potential buyers would look like based on the makeup of your agency, and also what profile would give you the most competitive buyer. Like, you need to know, as people are calling you, would they be the most competitive buyer? They need to check all the boxes from a culture standpoint, but you don't want to just answer the first person who calls, because they might not line up with your carriers. They might not line up with whatever. and they won't be a competitive buyer in that situation. So I can counsel based on where you are and where you want to go.
It's a great answer, but I'm gonna have to give you a couple hard ones.
I can't wait. I love hard ones.
So hypothetically,
Yes.
how do you tell your seller how to weigh out the different buyers? There could be multiple competing dollars and numbers. And, let's just say buyer A, they want 100% cash. Buyer B, 80-20. But there's a stock option. Like, are they going to places? Is this a private equity? Do we want to hold on to those stock shares and wait for them to go to places is that a risk? Right? And buyer C, they're going to give you the biggest earnout number uncapped. So, those are the three things that we don't really talk about it. Insurance agent will spend 99% of their career, their life building asset and spend 1% of their time figure out how to maximize that last exit, right?
Sure.
The last journey is the hardest one, but also the most rewarding one. So
yeah,
when you talk to your seller, I am Jeff, I am your seller. Talk to me about buyer A, buyer B, buyer C. How do you present those things? And I just want to hear come from you how you present the differences to your seller.
Well, I think it starts with you. Like, what is your comfort level with certain things? So number one, buyer A was 100% cash. You drop the keys and leave. That's what I heard you say. So it will be the lowest price because the buyer has all the risk in that situation. First of all, I would explain to them why those deals are so different and what the give and take is. So if you are at a point in your career, if there's a health issue, if there's a family issue, if there's whatever, that might be the best situation. But the good side of that is you are able to move and do whatever it is that you have that's immediate in your life. If you're not ready to leave, that might not be the best situation because you still have some fire in you, but you want to take some chips off the table. You have to be honest with yourself. If you take option 2 or option 3, are you actually willing to work for someone else? And honestly, it's one of the most underestimated questions because the reality is most agents, by the time they get to this decision, have been their own boss for 15, 20, 30, maybe even 40 years. So you have to be really honest with yourself because option 2 and option 3 both have an earnout. You have to stay involved for a period of time and you have to perform, or you've got to bet on the parent company performing, which means you some level of involvement on your behalf working with someone else. And if you're not willing to do that, you're going to be really unhappy for the last few years of your career. That is something you have to be honest about. There are plenty of people that chase the dollar, which is higher, but underestimate what that actually is. The second thing I would tell you is if the earnout has goals that you've not met on your own for many years, why in the world would you think that those goals would actually be met in the last years of your career, right? So we have to take the emotion out of the numbers and actually be practical about, do we really believe that this is something that can happen? Is there some other thing that we're adding to the mix that's going to allow you to be able to hit those goals? If not, that number doesn't matter because it's not going to happen. So that's how I would advise it. I would break it down to say, hey, listen, your growth rate didn't go above 5% for the last 15 years. They're asking you to hit a 10% in order to get this earnout. You can only consider the 2 to 5% realistically. You know what I mean? Like, don't even count on the number that's 10 if you haven't gotten there. So I would break it down and ask them, how hard do you want to work? How sure are you can take direction from someone else, and let your team take direction from someone else? And if not, we got to be realistic about it. So
I'm going to compartmentalize even further. Buyer A is easy. Buyer B is a little bit tricky because we're talking about shares, right?
Sure.
I'll give you 2-part question. When you are a fractional CFO, when you're taking over someone's books, most agents just understand profit because profit is what they cut themselves a check and pay Uncle Sam, right?
Sure.
They always remember the profit because right after profit is Uncle Sam, right?
Sure.
So, but the thing is, in our world, we are working with a thing called EBITDA. You have to dumb it down for some of the audience who don't live in this accounting world. What is the difference between profit versus EBITDA?
Yeah.
So that's the first question I'm going to hit you with. And then the next one is if you are looking at buyer B, but the thing is, hypothetically, there's multiple buyer B, right? One is a traditional, your top 10 PCF, Acrisure, Gallagher of the world. And then the second one is a new income private equity. They're sitting on $750 million of fund of a private equity, and they have a lot of access to that capital fund, right? So 20% share over here or 20% share over there. Walk me through what I should be thinking about. And if I can, I'm turning it back to you.
I love it. So first thing, what's the difference between profit and EBITDA? Easy question. And there's a little noise out there about EBITDA, so I'm glad you asked me the question. EBITDA is the operating profit of an organization. And in layman's terms, that means your P&L, your profit and loss statement has things included in it that are one time. They're never going to repeat. It might be an investment that you made. So those would be eliminated. Your profit and loss just is your profit and loss. It's the revenue less the expenses gives you profit. In any period of time, that's what the profit is. But an EBITDA is a pro forma. You actually adjust that profit and loss to say, what will the ongoing cash flow expected from this agency be from the operation of the agency? So any one-time expenses are eliminated. Actually, any one-time revenue is eliminated. If you have something that isn't going to renew, like a bond, if you have a huge bond book, it's not going to be the same. Like you have to know what's going to renew. PPP loan is a perfect example. Everybody and their brother had that on their P&L. You got to take off the one time. So that's an easy thing to think through. The second is, what about the things that they were discretionary? They might have been investments that you were trying something out, but if you're going to sell that business, you're not going to be discretionary about anything. We got to get it down to the bare bones of what does it take to sell insurance and what does it take to operate this business. There's other discretionary expenses that are put through a P&L for tax purposes to reduce your tax liability. Those come out. The last is owner compensation. Owners pay themselves in a million different ways and depending on the advice they get from the CPA that they use or the accountant that they use, they might be putting all of it through a W-2. Hope they're not doing that. Or they might be putting a portion or all of it through distributions. But we've got to put a reasonable amount that an owner would make in order to get to the true EBITDA or true ongoing operation, because the reality is whoever runs this business is going to pay themselves something. So it's got to be a reasonable owner compensation, eliminate the one time, and get to the ongoing cash flow that you can expect or ongoing operating profit that you can expect from this business. So that's the difference between just doing the simple math on the statement as it comes out versus the pro forma. The other thing is, if you don't know some of them, we'll use industry averages in order to get to what that pro forma EBITDA would be, because oftentimes there's not great financial reporting. I'm just going to leave it at that. So, right, like what is a reasonable expectation of what it would take to run this business? So that's your first question. You want me to pause there before I answer the second one?
No.
Okay. All right. The second one is, I have two buyers. One's an established private equity buyer and one is brand spanking new. So just think about that. Someone that's established, you'd be able to look at their track record and be able to say, if I'm going to take shares in a company and I'm able to see their track record, I might have more confidence in what their ongoing performance would be. You might, right? So it really depends on the advice that a seller would get in order to be able to weigh those two. So in one hand, you've got ongoing performance that you can say, hey, listen, this is what their share price has been. This is how it's performed over time. This is how they've recapitalized. This is how they're funded. Therefore, I could anticipate that my shares might be worth X, Y, or Z in the period of time that I would have to hold it. And it's calculated into my total potential payment for my agency, but there's risk because from the moment I'm issued those shares to the point where I sell it, I'm taking on risk. So you can use their track record to be able to determine what's a reasonable expectation of what those shares are worth. The one that doesn't have the track record is brand new. They're buying new agencies. The way for you to weigh that option is, number one, who are they targeting? Are they targeting growth agencies with young owners that want to have high growth, high returns? Are they targeting agencies that are all 70 years old and walking away? Like, what is their strategy? How do I fit into the strategy? And how could I imagine what they're telling me their stock price would be worth? Like, you have to be reasonable with what they're trying to do. And honestly, could be one of the best investments you made because they'll have hockey stick growth before they recapitalize, where the other established has already recapitalized. I'm not saying they don't have growth. They just have different growth than the second one. But you have to know what you're doing to know, is that hockey stick growth going to actually come to fruition?
So, listeners, if you did not capture all of that, I need you to go back and re-listen to that, because what you just said is not said enough. And, a couple of good friends of mine, I'm not sure if they're ready for me to drop their name, but I talked to them 3 years, 4 years, 5 years, almost every year after their initial first exit. They got to their earnout, they crushed their earnouts, right? And I asked them, what would you have done differently? And two things they said was, A, they wish they took on more shares. At the time, they were worried. They want to say, cash is safe.
Sure.
They took as much cash. And they said, if we had to do it all over again, we would have took more share because their share in value doubled 3 years later. And the second thing they said was they wish they have negotiated a bigger earnout model, uncapped earnout model. And that's something that is actually negotiable. Not everyone want to negotiate that part, but
Sure.
if you can treat me like the first time I'm hearing this whole concept of earnouts, and how does earnouts work?
Yeah, I love that question. And the other thing I would just respond to what you just said is, it's really sad when someone looks back and they have regrets. So the other thing I would tell you is, you do this one time. You get to sell your life's work one time. And if you have to give it the time to actually get educated. You have to know what your own risk tolerance is, but you need someone to advise you that has seen it more than once, because you're going to see it one time. So please, Lord, if I could give a great advice to everyone, is if I was selling my agency and it's got serious value and I've got a runway, why you would not have representation in that is crazy to me. Just like if you sold your house, you need representation in order to do that. So please, please, please. So earnout is, well, when people say I sold my agency for X times EBITDA or X times revenue or whatever they say, there's components that go into that thing that they're quoting you. That's a headline. Nobody then follows up and said, well, how did you get to that number? And typically there's a base multiple that is given to you in cash. There's some amount that's either cash or cash and stock in a base amount. Okay. The second is, something has to happen for a period of time, which is called your earnout. Typically an earnout, it can be anywhere from 2 to 3 years, could be 1 year, it could be whatever, or it could be multiple levels of an earnout. If you do such and such by the first year, such and such by the second, such and such by the third, it's a tiered approach. And there's typically a retention and a new business component to that earnout. It can also be that you maintain the EBITDA and the growth rate. They'll manage top line and bottom line and make sure that what they bought continues to perform and grow. And if it does, you will get yet another payout. The person quoting you is going to tell you as if they maximize their earnout what they sold their agency for. But the reality is nobody goes back after 3 years and says, what did you fully get? Do you know what I'm saying? So the earnout it's a variable amount over a period of time based on performance. Could be profitability, could be growth, could be retention, could be all three.
What are some of the current 2024, September 13th, as of the recording of this podcast, what are the common number you are seeing today on earnouts offers?
So Jeff, that's a super loaded question because remember, there's 40,000 independent insurance agencies across the country. So let's start there, because I think one of the worst things in the world is when people hear this soundbite and they apply it to their agencies. So I'm going to start with 40,000 independent insurance agencies across the country.
That was your disclaimer. You started with a disclaimer.
Yeah. 83% of independent agents are under 1.25 million. That's their revenue. Under 1.25 million. Okay. That's where, if I'm looking at the whole body, there's only the difference, which is what, 17% that are over 1.25 million. When you hear quoted multiples, it's typically for platform agencies that are 2 million, 2.5 million, 3 million plus. Those are the ones that get published and say there's a base of 10 to 12 times EBITDA plus another 2 to 3 times earnout to get to a 13, 14 multiple. You know what I'm saying? The problem is everybody's reading that and applying it and saying, if I have a $750,000 book, I must be able to get 14 times EBITDA. That is not the case. It doesn't work that way. You have to have volume. So the things that matter when you're looking at these deals are, is the business growing? Is it profitable? Do you have volume? And is it transferable? Meaning, can I expect this business to continue to operate well when something changes like owner? Or is it really dependent on the owner's relationships, the owner's, whatever? Is it really dependent on their lead carrier and we can't get that lead carrier to happen? Is it really dependent on something that isn't transferable in that transition? So those multiples that you see headlines are a problem because they don't apply to a big majority of the market, but they're the only thing out there. When I see a bank loan involved, which means agency to agency, and there had to be a bank loan involved, the metric or the multiples are somewhere between 7 and 8.5 typically. Like that's the average, just so you know. So big difference between a 14 multiple and a 7 to 8.5. And with interest rates rising, they're getting pressure because you've got to have either enough cash to put down in order to be able to get to that 7 to 8.5, because the bank has an EBITDA to debt ratio that they have to stay under. So it really has changed the number of buyers, but also some of those multiples that are agent to agent and not agent to PE. So the big disclaimer, one of the worst things I think are the multiples that are quoted that people hear and then apply to their agency.
The more you talk, the more questions I have. I'm like, this is a great question for Carey. And then I have 3 more questions. I forgot the first question I was going to ask Carey. And you know what, Carey, we can't do justice if we just have you on the pod one time. So we got to get your daughter back with you. We got to get you back. But let's talk about, what does your travel look like? I mean, you got a lot of agency you're working with. You're constantly behind your desk, cranking the numbers, talking to your clients. Is there a travel coming up in Carey? Are you speaking this coming last quarter of the year? How are you closing out 2024? And, if we talk about goals, right? Because every entrepreneur has goals. What is the 1 or 2 comfortable goals you have? And what is the uncomfortable goals you have? Would you like to share with us?
Sure. So let me hit the travel one first. So, Agency Focus is 3.5 years old, which I'm super excited about. And last year I spoke a lot. Like I traveled a ton. I got in front of agents a ton. I think I spoke at about 36 industry events last year, which was a lot. This year, someone challenged me and said, if you could only take 12 flights to grow your business, what would they be? And that actually hit me and influenced how I planned for 2024. So I actually...
Who said that to you?
Seth Zaremba, actually. Yeah. So Seth is he was on the board of the Agents Association.
Yeah. I love to just sit around, have a couple beer with him. So just a little plug. Seth is a genius. All right,
he is a genius. Yeah. So honestly, he's influenced a ton of my career. He was on the board of OIA that led towards data, led towards Intel agents. Like that's one of the reasons I stayed in this industry is I got to meet agents like Seth Zaremba, Matt Simon. There's a ton of great people that sat on that board that are 100% the reason I'm in this industry, just so you know. But anyway, he challenged me and said, if there was only 12 flights, what would they be? And I actually took it to heart. So I'd already committed to a couple, by that time, but I was pretty intentional of where I would be and what I thought would actually help me. And I think I'm going to use that same mentality going into 2025. So I do travel and see my clients. I try to do that at least once a year. My fractional CFO clients, I can't do that for all the valuation clients, but my fractional CFO clients, I try to see them. I'm actually speaking at INA next year, which I'm really excited about. I'm ending the year at ITC. Matt Namoli and I are doing a little session at ITC, which I'm excited about. Like there's some, I'm going to speak at CAA next year and do a boot camp on acquisition and preparing for acquisition and think many of the questions you asked me. So there's a lot of places that I want to be, but that doesn't mean 36 of them. That's not a great way to, not burn out from the traveling, which I love to be around people, but that's a little much. So that is what my travel schedule looks like. My goals, I have tons of goals, I'll tell you, but my biggest goal is, when we founded Agency Focus, the goal was pretty clear. These things are complicated and agents need help simplifying it and having the confidence to make strong decisions. So I feel like we've done a good job one-to-one. We need to do a better job one-to-many. So you're going to see a rollout of courses that people can take so they can actually do, and probably, a mastermind where people who are contemplating these things and want to bounce ideas off of each other. I'm all about bringing a community together. So that's my big audacious goal for 2025 is to create that. So people that maybe don't want to do the one-to-one, but they want to do the one-to-many and really think about this and plan for their business. We want to continue to expand how we do that. So that's my big thing that you'll expect to see from me.
I have an idea for that one.
Great.
We need to connect offline. So
let's do it.
All right. Oh man, this is so good, but we just didn't book enough time. We need like 3-4 hours and like coffee.
Well, you're gonna have to come on mine because I'd like to know the Jeff Shi story. Like we got to figure this out, Hey,
I'm a guest too. So if you want to book me, you and Lindsay can shoot away. So, but we need to get you and Lindsay come back on. So that's for sure. And, I browsed her LinkedIn a little bit and then, she's doing some fun things. So we get to hear her talk about it too. But, just thank you very much for coming on the podcast. And I hope our audience really had a good time listening to this episode because you just dropped a lot of knowledge. And what I'm going to do is I'm going to put all your links in the comment section and how to reach you, how to follow you, how to listen to Agency Focus advice, and also how to connect with your podcast, your Refocus podcast. So I'm going to put all the links below in the comment section, and I hope they reach out to you. So thank you very much for listening to this episode, and have a good one.